All right, so let's go over. I'm gonna go over the 6 types of life insurances. Okay, because I believe it's important for us to understand that there are 6 types of life insurances in North America. And by the way, these are the only ones that are out there. There's no more extra ones. Actually, if you see that a company sells more than these, it's because they have a variation of them. But these are the 6 core types of insurances, and I'm gonna show you how they work. All right. The first one, it's called a group insurance. This is the most common one. This is the ones you might get at work. It's bought by the company, so the company is a policy holder, right? So you're not the owner, the company is a policy holder. And let's go over the pros. The pros is that it's cheap, it's inexpensive, and there's probably no medical checkup to get it. Okay? So let's go over the pros. That's it's cheap, it's inexpensive, and there's no medical checkup. The cons, the bad thing about them is that typically they don't give enough coverage. So they're usually policies for like, 100,000, 50,000, 20,000. It's never enough coverage. The second thing is that, well, like I said, you have no ownership of the policy, so you have no control over how it works. And therefore, a lot of people, since they don't have any control over works, they never read their documents and they don't understand that 90% of these policies, they do not pay. Do not pay. Why is it? Because they have too many exclusions. You have to die in an accident. You have to die at work. If you're not an employee, it doesn't cover you. Sometimes it doesn't cover you if you're not working with them. It doesn't cover you if you die of a health condition, of cancer, of something health-wise. If you are driving and you have a little bit of alcohol, they'll consider that a DUI, and it's your fault because you were drinking. So there's so many exclusions that typically 90% of the time it doesn't pay out. So that's group insurance. Okay. The second type of insurance is called AD&D. AD&D is accidental death and dismemberment. So dismemberment and accidental is pretty much a rider. Okay, what does that mean by that? That means that these policies, the pros, let's go over the pros, is that, again, they're cheap. They give a lot of coverage. Now, these ones give a lot of coverage, right? They're cheap. And, again, a lot of them don't need any medical. Now, why is it that they don't need any medical coverage and they could give you like $500,000, $1 million of coverage? Because again, these ones, 90%, these are the cons. 90% of these policies never pay out. Never pay out. Why is it? Because you have to die at an accident, but you have to die the way they want you to die. The way they want you to die. So what does that mean? It means that if you don't die at the scene of the accident and you die at the hospital, well, that would be considered like hemorrhaging from blood, or maybe something that your heart failed. So in that instant, you didn't die at the accident, so you died at the hospital, so they don't pay out. So the cons are there's a lot of exclusions. Again, these things work exactly like these ones. It's just AD&D. The pros, I mean, I don't think they're pros, but they're cheap. They have a lot of coverage. And these are the type of policies that they sell you like at the bank, JCPenney, right? Through the mail. This is a lot of it through the mail. So let's go over the next one. So this is 1, 2, and let's go over 3. The third one, this would be called return of premium. Return of premium also has a name by Universal, right? Or flexible. But again, don't get deceived. This is a return of premium policy. Okay. Now, what are the pros of this policy? The pros of this policy is that they're term, meaning they're inexpensive. They're not cheap, but they're inexpensive. They're very affordable. And the pros is that if you don't die, they give you all the money you paid back. So sounds like a good deal, right? So let's say that you have a policy for $250K and you're paying $70 a month. Well, in the time of 20-year term, if you paid, like, let's say $20,000 and you don't die, you would get those $20,000 back. And a lot of people buy them because of that. But what they don't understand is this, that in the con of this policy is that it's a group policy, right? So we already found out what a group policy is, right? But it's disguised as a return of premium, which means this, okay? This is the most important part of this. They will honor this part, but unfortunately, you're not the policyholder. So the owner of this policy is, like, let's say a trust, and the company, let's say it's ABC Insurance, they have a contract between them. And then you, as a certificate owner, get little certificates for owning that policy. So what does that mean? There's two contracts going on here. One between the trust and the insurance company, and one between you and the certificate. So it's kind of like if you had a car that you were selling, right? And you had the title to the car and you wanted to sell it to another person, but you tell them, the only thing that I'm going to do is I'm going to register this car under your name, but I'm not going to give you the title. Would anybody buy a car like that? Of course not. And that's how this company works, because what they do is they have a policy owner and the company, and then they're saying that if we want to, we'll honor this, but you're not the owner, you're the certificate holder. And we already found out what happens in the certificate holder. You have no control. So you have no control of the situation. So basically, you're buying an insurance policy that might or might not work out. So a lot of people don't know that it's a certificate. That's return of premium. The fourth one is called cash value. Now, in cash value, the pro is that most qualify. So a lot of times, you know, even if you don't need a medical test, they'll qualify you. The pro is that you get money back. You get some money back, right? If you don't die. Okay? If you don't die. But here's the con. Okay, there's a lot of cons. With whole life insurance, whole life, you always buy two things, but you only get one, right? So in this policy, if you die, the company keeps your cash values. The company keeps your savings, okay? And for the first 3 years, you have no savings. So imagine going to the bank and you're giving them, I don't know, $120 a month, right? For 3 years. And you go to the bank and you ask for your money. And the first thing they're going to say is like, you have to borrow your own money here. So they're going to give you a loan application. So that tells you that that's a scam. The second thing is that for the first 3 years of you putting money in, there's absolutely zero cash value into that policy. There's nothing going into it. So the first 3 years, you lost your money. You don't see any money until after the fourth year. And then you have to pay interest to borrow your own money. And to top it all off, like I mentioned before, if you were to pass away, you buy two things, but you only get one. So what do I mean by that? Let's say that you get a $150,000 policy and you're paying $120 a month. And you pay that thing for 30 years. And in 30 years, you accumulated $70,000, right? But let's say right before the 30 years, you die. Logically, you would say that if I have about $60-some thousand here, that your family would get that money. Well, no, the company keeps the savings and all your family gets is $150,000. And that never makes sense, ever makes sense at any point. Buy term, invest the difference is the best thing to do, because if you were to buy a policy for $150 at like age 25, it would probably be about $35 to $40. And then if you were to save that difference, like $90 over a period of 30 years, you would have about, I want to say $300,000, and you would have your policy of $150K. And if you die, you get both. Your family gets both because they're separate. Okay, so that's the cons of cash value. So let me tell you the fifth one, which is term. Okay. Term is pure protection. Okay. The pros is that it's inexpensive, it's level up until age 100, right? I mean, level up until age 95, and then it becomes, but you can renew it up to age 100. You get the right coverage, and you can get the proper protection. And these policies, they have no exclusions after 2 years. No exclusions. The only exclusion they have is in the first 2 years. And as you guys know, it's suicide. But after 2 years, there's no exclusion. So you die, we pay. That's pretty much it. What are the cons? Well, the cons are that if you don't die, well, you don't get anything. There's no money in it. But that's why we design mutual funds and IRAs. So this one is the least is the one that has the most pros out of all these. Again, these are all, they come in different variations, but this is the basic criteria of every policy. And if you guys just learn how to explain this example, you're going to educate clients. You're going to be able to help them out. And when somebody tells you, I don't know what I have, all you have to tell them is this: look, there's only 5 types of insurances. Which one do you have? There's no other ones. It might be called something different, but these are the only ones that exist. And so you ask them that question, and I promise you people are going to know exactly what you're talking about. And 9 times out of 10, Primerica beats all of them in benefits and cost over a period of time. But just use this information. If you have any questions, just hit me up, but I'm going to have this for you guys, all right?